Let's talk now about the statement of cash flows. I think this is actually probably the most important statement for us to look at. It's my favorite. That's where we can get the most information about what's going on with companies. It does tend to be ignored sometimes. Okay, so I really want to emphasize that we can get a lot of information from the cash flow statement. Okay, let's look at a cash flow statement here to try to figure out what does a cash flow statement measure. So you have DirecTV, okay, again for the latest 12 months and for the 2 previous years, right? So here, the first item in the cash flow statement is going to be net income. Okay, so you're going to start from the bottom of the income statement, and then you're going to start adding and subtracting items. And there is a very important rule that you should remember. Don't forget this. The sign of a number in the cash flow statement is very meaningful. Okay, so for example, let me go here to emphasize this. So here you have change in accounts receivable. Let's just use that example. Okay, this is minus 189. Okay, what this means is that accounts receivable provided a cash flow of minus 189 million in that period. Okay, so 189 million of cash came out of DirecTV in that year because of accounts receivable. And you can use the same rule for everything. So for example, if you look at debt issued, that has a positive sign, right? Which means that debt came into the company, so cash came into the company in that year, right? So the signs mean a lot, okay? So here you have, there are 3 parts in the cash flow statement that you can see here, right? There is the operating cash flow part, which is the top of the cash flow statement. So you get to a measure of operating cash flow. That tells you how much cash flow the company has generated from operations, okay? And then we have investing cash flow, okay? So investing cash flow will generally be negative. You can see here that it's minus 3.3 billion for DirecTV, okay? So that means what? Remember the sign, right? It means that DirecTV invested 3.3 million in that year. Okay, and then at the bottom you're going to have the financing cash flows, right? Cash is going to go in and out of the company as well because of financial decisions like dividends. Okay, you can see here that DirecTV is not paying any dividends. Okay, but they are issuing debt, repaying debt, issuing stock, repurchasing stock. So at the end, you're going to get a total cash from financing. In this case, it's minus 1.7 billion. Okay. So again, what does that mean? It means that DirecTV paid $1.7 billion of cash to investors in that year. Okay? And then at the end, you're going to have the net change in cash, which is the sum of everything. So that's the total amount of cash that the company generated in that year after taking into account operating, investment, and financing activities. Okay? So there is a lot. See, just by this discussion, you see that there is a lot of information in the cash flow statement. Right? A lot of useful information about what's going on with the company. Okay? For you to understand that better, okay, I actually want you to work with an example. A simplified example before we go back to the cash flow statements for DirecTV and Cablevision. Let's think about what's going on with these companies. We have 4 companies here, A, B, C, and D, okay? And I gave you the main items that you see in a cash flow statement: operating, investment, and financing cash flows. Okay? And the question that I want you to think about using what we just learned about the cash flow statement is, which of these companies is likely to be a startup, a new company that is growing, that is being started up now? Okay? Which of these, A, B, C, or D, is likely to be a startup? If you look at that data, right, it should be clear that the company that is most likely to be a startup is company C, right? Why? Because company C is generating negative cash from operations, it's investing and raising money from investors, okay? Let me go back here just to the table just to make sure that you understand that, okay? So here, company C, right, has negative cash from operations, minus 400, okay? It's investing, right, minus 200, let's say million, Okay, the unit doesn't matter much, let's say million, and it is raising cash from investors, right? So that is a typical situation of a startup company. You're borrowing money, you're not profitable yet, but you're investing in the business because you probably expect to become profitable in the future. Okay? So that's how we can use the cash flow statement to really drill down and think about what's happening to companies. Okay? So the other companies, we can talk about them as well. Company B is a mature company that is downsizing, right? How do you know it's downsizing? Because the cash from investments is positive. So instead of investing in the business, company B is generating cash by selling off investments. Okay? Company A is a profitable company, right? How do we know? Because it's generating cash from operations, but it is also raising additional financing. And finally, if you look at company C, it has a negative change in cash. Okay? So in that year, company D did not generate any cash. It lost some cash. What will happen to the company? Is that bad? You know, let's go back here. Think about that. Not necessarily, right? So cash went down for that year. What will happen is that there will be a reduction in the amount of cash that the company has in the balance sheet. Okay? So this company has to be able, it should be able to use its cash that is in the balance sheet to finance this. Okay? And if it's not, then the company has to plan some additional financing. This is something we're going to be talking about in Module 2 when we talk about financial planning. That's going to be a very important idea. That's going to be how we're going to figure out whether a company needs new external financing or not. Okay? So the profitability ratios that we can compute using the cash flow statement are similar to the income statement ratios we talked about, but they are based on cash profits. The most important ratio is it is the only one that we're going to emphasize here, is what we call the cash profitability ratio. Okay? It's just the operating cash flow divided by total assets, right? So it's very similar to ROA, but instead of OPAT, you're using operating cash flows. Okay? Think about, so here is a calculation for you for Cablevision, again using the latest 12-month period. Okay? You have cash from operations here, which is 1.3 billion. This ratio is very simple. You just have to divide cash from operations by total assets. For Cablevision, this would be 0.20. Okay? And you can do the same thing for DirecTV. You should get a ratio of 0.26, right? So both of these companies seem to be generating a cash flow from operations, right? They are cash profitable, right? And in addition, if you look at the cash flow statements for Cablevision and DirecTV, what you'll see is that both of these companies have negative cash flow from investments, right? And have negative cash flow from financing, right? So let's apply what we just learned about the cash flow statement. What does that mean, right? It means that both of these companies are investing in the business, but they are not raising new financing from investors. They are returning cash to investors, okay? So if you go back here and look at the cash flow statement for Cablevision, okay, you'll see that Cablevision, for example, is issuing new debt, 1.3, but is also repaying a lot of debt. Okay. In addition, they are repurchasing stock. Okay. So on average, in the latest 12 months, there was no new financing entering the company. The net amount of cash from financing is negative, meaning that Cablevision actually paid off a cash to investors. Okay? Which is a common situation for US companies these days. We're going to talk more about that when we discuss our assignment.